Good morning, and thank you to Public Service Events for organising this conference and inviting me here to speak today. I'm going to talk this morning about the fiscal background, how bad the situation is at the moment, why we need to get borrowing under control, and how best we might think about doing that. Improving the way that taxpayers' money is spent is absolutely crucial. It's clear that even with the continuing economic weakness, whichever party wins the election is going to have to cut spending. And if we're going to maintain good quality services for people and good quality infrastructure for businesses, everything possible will have to be squeezed out of fewer resources. So I hope that today's conference will generate a lot of good ideas about how to deliver more effectively. Let me first make a few points about the UK's fiscal situation. We all know that borrowing is at record levels at the moment. The Treasury's pencilled in £178 billion this year, £176 billion next year. Given how bad the January borrowing figures were, we may see an upwards revision to those figures in the budget in a couple of weeks. Other expert organisations are predicting even worse. The OECD reckons that borrowing will peak at 13% of our national income, which is more like £200 billion. Capital Economics has forecast borrowing totalling £1 trillion over the next 5 years. But whoever turns out right, we can all agree that borrowing is at a pretty frightening level. And of course, it's not just the headline borrowing numbers. We know that borrowing rises in a recession. Tax revenues fall, unemployment benefit payments automatically rise, and that's a good thing. It's also a good idea to give the economy a bit of a kick-start with some discretionary extra borrowing, which complements interest rate cuts. Given how bad the situation looked 18 months ago, it was right for the government to throw everything it could at it. But the real worry is how much of the borrowing is not due to temporary factors, such as these. The Treasury reckons that the structural budget deficit is around 9% of GDP, or around £125 billion. And others, such as the European Commission, think it's even higher. And of course, this excludes the fiscal stimulus, as well as the higher welfare spending and lower tax revenues that are just due to this recession. This structural deficit, which is caused in part by a permanent loss of tax revenues from the city and from housing, is what we have to worry about. And this is not going to be tackled unless something is actively done about it. But there are two competing pressures. The first is the risk that investors in government bonds lose faith in the government's ability to tackle the deficit. This argues for early action to cut borrowing. The second argues for the reverse. If borrowing is addressed too soon, through lower spending and higher taxes, it risks choking off the recovery before it has really taken hold, and that could make it harder to cut borrowing in the longer term. Although, having said that, there may be a boost to the economy from ending the uncertainty over fiscal policy, which may partly offset the effect of fiscal tightening. But getting the timing right is both crucial and difficult. Of course, the two main political parties have had a public argument about the issue of timing, with a letter to the Sunday Times from 20 economists calling for early action, swiftly followed by 2 letters to the Financial Times calling for greater patience. But I think the issue of timing is important, but it is of secondary importance. And we shouldn't be distracted too much by these pre-election arguments. For make no mistake, a failure to bring the structural deficit under control risks being disastrous for the UK economy and for the stability of public spending. Now, the Treasury thinks that the cost of paying the interest on government debt will go up by close to a half next year, to almost as much as the defence budget. This forecast is based on the current low interest rates on that debt. Now, if a lack of credible promises to tighten fiscal policy cause the bond markets to lose confidence in the UK's fiscal sustainability, the cost of government borrowing will shoot up. The Institute for Fiscal Studies has calculated that a 1 percentage point increase in the government's average interest rate would raise the debt servicing burden by around 1% of GDP, or £15 billion a year. Now, of course, that's £15 billion a year less for public services. And as recently as the 1990s, the average interest rate on government debt was 7%, nearly 3 percentage points higher than today. Now, for the time being, investors do seem content to wait and see, but that could change quickly, and cracks are appearing. The Bank of England has stopped creating money to buy government bonds for now. When it starts to sell them, bond prices could fall and yields rise. And there's still a risk of a credit rating downgrade for the UK, which would certainly lead to a spike on interest rates for new government debt. Opinions vary greatly on how large a risk this is. Although the main credit rating agencies have not indicated that they will downgrade, they have all indicated that faster action to reduce borrowing is necessary for the UK to retain its AAA-rated status. And just on Tuesday, Fitch said that it was uncomfortable with the fiscal adjustment path currently set out. and said that without a credible plan, there would be more pressure on the UK's AAA status. So I think it all feels like a bit of a high-wire act at the moment. If the Bank of England and the Treasury are right and growth recovers to above 3% next year, it could all look spectacular. But I think there's also a very big downside risk of a loss of confidence leading to higher government bond yields, and then you risk getting into a vicious spiral of higher debt and higher debt servicing costs, which would do economic recovery no good at all. Now, of course, the IMF is the ultimate backstop if things go seriously wrong. But as in the 1970s in the UK and over many decades across the world, the IMF would require drastic spending cuts as a condition of aid. So I think it's better that we get it right and we get a credible plan in place to cut borrowing, even if it's also right that we shouldn't start implementing most of it straight away. What is the best way of reducing borrowing? Well, I think there are 4 possible ways. The most painless route is through a rapid and sustained economic growth, but this is highly unlikely to be anywhere near sufficient. The Treasury forecasts that net borrowing 4 years from now will still exceed 5% of GDP, or close to $75 billion in today's money. And this forecast is based on an assumption that growth will return to above 3% in 2011 and stay at that high level. So even after a rapid and a sustained economic recovery, and together with the government's existing plans to tighten fiscal policy, borrowing would still be at an unacceptable level. Growth will help, but it's not near enough on its own. So it could be very tempting for a government to create a bit of inflation for a few years. This would reduce the real value of government debt, but of course it would also erode the real value of people's savings, punishing the very behaviour we want to encourage following the excess borrowing of the financial crisis. Now, thankfully, the independence of the Bank of England means that, in theory at least, a government in the UK can't do this. It could obviously change the inflation target or lean on the Monetary Policy Committee in other ways, but it really is not an ultimate control. And of course, there's a risk that the quantitative easing programme won't be unwound in time, leading to higher inflation, but people investing in longer-term government bonds don't seem to think that a serious risk, for now at least. That said, inflation in January reached 3.5%, well above target. We must hope that the Bank of England is right, that this is mainly due to the VAT rate going up and to the effects of a weaker pound, and that inflation will quickly fall again. So if a return to strong growth is not sufficient and a dose of high inflation not very likely, the 2 painful choices do have to be considered: cutting spending and raising taxes. The positive side of these 2 options is that tight fiscal policy does allow interest rates to stay low for longer. And when deciding upon the mix of spending cuts and tax increases, it's vital to choose the path that damages economic growth the least. Otherwise, the task is made all the more difficult, and the cuts and the tax rises have to be all the larger. Now, if the financial crisis has taught us anything, it's that economic theory and modelling is a long, long way from being an exact science, even when all economists agree on something, which is a very rare occurrence. But, that caveat aside, the literature is pretty clear that cuts to government consumption spending and increases to indirect taxes are the least damaging to growth. So if you must put up a tax, then raise VAT. And if you have to cut spending, then focus on cuts to government programmes that are not delivering good results. The effects on growth of increasing income and corporation taxes and cutting spending on investment in energy and transport infrastructure would be far worse. But the economic literature actually goes further than that. There is evidence from the European Central Bank and others that cutting government consumption is actually positive for growth in the long run. So doing the most painful thing may actually be the right choice over time. And there is also a lot of empirical evidence from the IMF and the European Commission that developed countries facing a budget crisis are more successful in pulling themselves out of it if they reduce spending than if they choose to raise taxes significantly. And I think when thinking about the policy mix in the UK, there's a further important consideration, which is the recent record of public spending. OECD comparisons show that the recent increase in government spending as a share of national income was greater in the UK than in any other developed country. Now, the OECD comparison looked at the period from 2000 to 2007, so it's pre the recession, doesn't take account of the extra spending we've had as the fiscal stimulus.